Welcome back. Mr. Sam Freshman will take the podium. Thank you.
Thank you. Come on. You can do that after we make a deal. All right, we have a nice panel today. We have on the panel, we've got Steve Bram and Jim Howell and we've got the John Schulhoff. And each of them, I think we'll start out by each of them giving you 2 or 3 minutes on what they do and what they're looking for and how they fit in with the panel. I think most of you know that we are not in the real estate business. We're in the arithmetic business. Number one. The second thing is, we're not, again, in the real estate business, we're in the leverage business. Does everybody here understand the difference between positive and negative leverage?
I could have brought the blackboard from my place.
Yeah, I know. I'll do it from my head. How many people understand? Okay, one person understands the difference between, we got 2.
Understand or who does understand?
Who does understand the difference between positive and negative leverage. Okay. Well, the rest of you, you're not going to succeed till you get that concept. Here it is. There's a number of key words that you have to have full understanding of before you go out and get a loan. The first is the difference between the interest rate and the constant. We just went through this at UCLA earlier this week. And don't feel bad because there were 30 kids in the room, all of them smart UCLA students. None of them knew what any of this was.
Well, they were intimidated.
They were intimidated. Okay. You've got interest-only loans, and you have amortizing loans. And amortizing loans mean usually an annual payment, which is fixed, of principal and interest, which amortizes off or pays the loan off over a given period of time. Now, those amortizing loans may go to full maturity or they may have a balloon. It doesn't matter for this purpose. Everybody got those concepts? No questions. All right. Now, the interest rate is not important to a long-term real estate investor. We often say, you tell me what the terms are, and I'll tell you the price I'll pay. So, given long enough terms and low enough interest, I'll pay more money. One of the things you want to do is be very careful to run the numbers to make sure that you have positive leverage. We only do positive leverage deals. So that means that the annual payment, principal and interest, to amortize the loan must be less. That's the constant. The combination of principal and interest must be less than the cap rate. Now, how many people know what a cap rate is? Those of you who don't know what a cap rate is, you should probably give up at this point. The cap rate is the annual net operating income in the absence of debt in relation to the original purchase price. So if you have a $10 million building and it brings in $600,000 a year, you didn't buy it in Southern California, you put it somewhere else. You've got a 6% cap rate. Everybody following me so far? All right. Now, if your constant is lower than the cap rate, That is, you've got a 5% constant. You've got maybe a 4% loan, and when it's amortized off, you're paying 5% constant. And you've got a 6% NOI or cap rate. You've got a positive spread. And your investors are going to be very happy. If it turns out that your loan rate is the constant on the loan would be 6 and your NOI is 5, you're going to have to go out of pocket. Investors are not going to be very happy. We talked before about what our criteria is, and one of our criteria is positive leverage. Now, with that, you probably know everything you need to know. Oh, no, somebody wasn't quite sure. Yes?
Quick question. Your taxes are included in the cap rate?
No. The cap rate is net operating income after taxes, after operating expenses, after replacement reserves. That's the net cash flow.
Asking whether real estate taxes are included.
Yes, you do.
Yes, of course. They're in your expense figure. They're up in the expense column. Now, Steve's going to tell you a few more tricks and introduce you. Each of you has a maximum of 5 minutes. Steve, you go first.
Good afternoon. It's nice to be here. The panel is all friends of ours. Nice to meet everybody. My name is Steve Bram. I believe there was a handout in the things you received which describes some of the things we do and describes what we do. I am a mortgage broker, commercial mortgage broker is the business that I'm in. And what that means is that I get hired by sponsors, borrowers to help them find loans or help them find mezzanine debt or help them find equity for the projects that they're going to do. So somebody like you or somebody like other sponsors who are thinking to either buy, refinance, acquire assets will come to us and say, this is what I'm thinking to do. I'm thinking to buy this thing or refinance this thing, and I need your help to fill up the capital stack. That could mean that we help them find senior loans, which generally go from 0 to 75% of value, mezzanine loans, which go from 75 to 90% of value, or equity, which generally goes from 80, 85, 90% to 100% of value of the deal. And we're able to find lenders or investors in any part of that part of the cap stack. They come to us because this is what we do full time. And we have long-term relationships with these lenders. The firm that I'm president of and part owner of is called George Smith Partners. And as I said, we're a commercial mortgage brokerage firm. We've got 38 brokers in the firm, and we arrange about $2 billion of loans a year that we close. During the peak years, we arranged up to $4 billion a year of loans, 300 to 400 loans a year. And those are all commercial loans, anywhere from $3 million up to $200 or $250 million per loan. Why do they come to us? They come to us because being in this business day in and day out, we can not only provide them guidance on the kind of loan structure that best fits their need, but we can also find those lenders for them. If I said to you, go get a loan from State Farm, you'd say, what do I do? Do I call up my insurance man and ask him? It's kind of hard to know where you find that guy. Or if you want a loan from B of A, guess what? You don't walk into a B of A branch. There are 4 people in an office downtown who do most all of the commercial lending for all of LA. And if I know that those guys have closed 5 loans with them in the last 2 or 3 years, I call them, they're going to pick up the phone and respond to me. And part of the process is working with borrowers, sponsors, and figuring out what it is that you want that fits what the lenders want. Because there's always going to be some variation between what you think you want and what I know the lenders will do. And if you come and ask a lender for something that's way off board, the lenders are just gonna, go on to the next request. So we can help clients figure out how their need can be accomplished in the financing world as it sits right now, because again, that's what we do day in and day out.
Okay, Steve,
So that's
thank
it.
you. Howell?
I'm Jim Howell. I'm with Freedom Capital. We're what was called, when we were set up 8 years ago by a large Western bank, a non-bank correspondent. It's our job to place this bank's loans through people like Steve's firm. Now, our loans are a little bit smaller than his. Most of ours run from $250,000 to about $5 million, although we have done some up to $10 million, particularly when they're partnered with the SBA or other assemblages, insurance conduits, and so on. But that is our job. We do only commercial real estate, and this is a bank that is not one of the 19 protected by the current administration, so they have to, the regulator pressure is pretty severe in terms of our credit box, but we're still doing a lot of loans, and a lot more now than we were even a few months ago, and for sure more than we were a couple of years ago. And I and Sam and Richard Zell and some other people had much the same roundtable up here. They are commercial real estate loans. They are limited within the bank's box. Virtually any type of commercial real estate property that's income producing or owner operated, such as a manufacturing firm that owns its own plant, a office building that you lease out is investor held. The bank has stepped away from apartments, hotels, and gas stations, particularly due to regulatory pressures. We could have that discussion elsewhere. It gets into politics and other things as well. But they do have two banks that are spin-offs of the primary bank that will handle those properties in certain situations. Apartments that don't fit HUD or Fannie Mae, Freddie Mac type financing, more conventional bank financing, and also for the gas stations and hotels, it's an even more limited box. It's what's called SBA 7A, which is an expensive loan, but it's a very doable loan for those types of properties. And in many instances, as Steve will probably back up, it's probably the only alternative available unless you have tremendous other assets of strength that you can bring to the deal. So that's what we are. That's who we are. We like working through folks like Steve, Kareem, Sam, Steve, and others because, and John, because we are strictly a non-bank correspondent. We're a middleman, but it doesn't cost the investor or borrower to work with us. The bank pays us on a quarterly production bonus. We've been with them for so many years. They look to us to deal directly with brokers and directly with the end users because they don't want to. They're not set up with the four guys like Bank of America has downtown to do the commercial loans. Okay.
Very good. John? You got the floor.
Okay. Good afternoon, everyone. A pleasure to be here. My name's John Schulhoff. I'm standing in for Brian Snyder since he won't see my name in the program. However, I prepared a short description of our company that's on the table in the back if you're interested. First Charter Capital is a California financed lender, licensed lender. We're a private money lender